Live really quick. This is going to be a very, very short video. I don't think I'm going to be able to get to anybody's questions, answers, comments, or anything like that. But there's a few things I want to talk to in the next few minutes here. So let's just kind of get right into it as we always do. The first thing I want to point out here is going to be the Buffett indicator, now approaching over 204%. This is definitely an indication to me that things are getting pretty extreme here. And I do think that we're going to have muted returns for many years following this year. I do think we're absolutely in a bull market. I don't want to take anything away from that. And I don't want to bet against a bull market. And so when I think about passive investing right now, I do think it's in a dangerous place because when we think about how the Buffett indicator has extended up to over 200%, it's really been a handful of names that's just got extreme valuations versus our GDP. It's not really the market as a whole. When we look at some of the bottom half opportunities, that's really where I've been focused, and specifically more defensive type earnings. I've been big on healthcare, as most of you know, probably almost to a default. And companies like Gilead Science and Pfizer come to mind as some of the best opportunities I think that are in the market for a very, very long-term investor, somebody who wants to reinvest dividends and still have pretty substantial earnings resilience, I think, in a downward earnings type of market that we're going to be in for many years following. So there's a couple things I want to point out. What could stop this bull market from going forward? And the first thing is I want to pull up the economic calendar because there's a few things that I think could stop this bull market. Okay, number one is obviously political tension. I'm just going to throw it right out there. I think number one, what could stop this bull market is absolutely more political tension. And when we look at valuations, which we'll get into in a minute, we're in the upper decile of valuations. So when we think about Buffett indicator at extreme levels, valuations on the market in the upper decile, high political tension, low unemployment, everything is really at a peak. And that's been my biggest thesis going into this year is that we are going to have a blow off top. Something probably similar to 2000, the dot-com bubble, where it was just extreme euphoric behavior and then it was an epic collapse that really took people by surprise. And I want people to think about the most popular stocks that are on YouTube right now. I'm not going to mention any names because I don't want to badmouth anybody's investment. But let's think about the most popular YouTubers out there. What stocks do they talk about? I think you guys can possibly put in the comments what stocks what stocks I would bring up. Now let me ask you a question. If there's this many geniuses out on YouTube who can pick these big winners, don't you think that's kind of euphoric? Don't you think it's impossible for everybody to get rich off these stocks? Don't you think that market pricing is at perfection at this point in time for a lot of these stocks that everybody's covering because they know they're going to get the views? So this is a very, very dangerous environment that we're in. And the way I run my channel, if you're new to the channel, I take a fundamental approach. So mathematics and reliant on true hardcore numbers and free cash flow is what we rely on for our rate of return, basically. We don't go off of hype. You know, yes, we can follow some management. We like to bet on management, definitely. I think that's a fundamental analysis that is important that we have to factor in when we're running our numbers, is that management having a good track record and being reliable is something that we need to really look at as a higher rate of return than what numbers can show us on a piece of paper. But when we look at economic data that's coming out here, on the 14th of this month, okay, we have producer price index coming in, okay, PPI year over year, core PPI year over year. And then Jerome Powell will speak at 10 a.m. So we're going to get a lot of data on Tuesday, and following after that, we're going to get a lot of data on Wednesday. What I want people to pay attention to is it's not the inflation. I do think inflation is going to come down. It's the erosion of the consumer that I think eventually the consumer will be completely tapped out and we will have some sort of rug pull event. And I don't know what it's going to be, but it always happens, ladies and gentlemen. Whether you want to go through the type of deficits we're running, whether you want to go to the dot-com bubble, the financial crisis, there's something that usually happens that nobody saw coming. And what could start preventing this bull market from going forward is definitely the next couple days here of data readings that are coming, right? Or the Fed speak that could be coming, or there could be a massive U-turn, or we could have all of a sudden rate hikes now back on the table versus rate cuts. And that's been a topic of conversation, but nobody's taken that serious. But if inflation's not under control, this could be a conversation that gets a little bit more serious. So let's talk about valuations. We talked about markets trading in an upper decile, and rightfully so. Why rightfully so? Well, because we're running historical deficits right now. Whether you want to talk about the CHIPS Act, the IRA Act, student loan moratorium, it seems like there's just free money all around us, and this market is based off of liquidity, not necessarily economic data. So when people are always talking about the market being different from the economics of true what we're feeling in the economy, it's very, very true, especially if there's a lot of liquidity flushed around. And that's exactly what's happening. There is a tremendous amount of liquidity flushed around. Earnings are coming in a lot stronger because of all this liquidity. And at some point in time, the euphoric behavior comes to an end, and it's usually pretty ugly. Okay. We're trading at 26 times earnings on this market, and possibly trading at 21, 22 times forward earnings. Okay. Which to me is about 25-30% overvalued. That's based on a consumer staying strong. Now, if the consumer weakens and data starts getting crazy, then we could be looking at a much higher valuation. So my concern here is if perfection is priced in, are we in basically peak valuations at this point in time? And where does it make sense to put money? So once again, on this channel, what do we talk about? We talk about trying to find companies that are not covered a lot, right? Companies that are kind of down and out, because that's where you're going to have the opportunity to beat the market. I think when we look at some of the companies that are covered extremely well, whether it's through YouTube, whether it's through, your hedge fund managers and CNBC and all these Fox News, all these channels that we watch for our financial data, when these companies are covered all the time, you're not going to really find any underlying deep value that is getting overlooked because it's being covered way too well, right? And when there's great stories behind these coverages, we see 10-15% moves, even though the fundamentals haven't even come through. And all we can look at is the AI talk, right? We've seen the AI talk get a little bit crazy here, and we've seen chip companies skyrocket on AI talks when there should probably only be one or two chip names that are really, really getting capital appreciation the way that they should be. But yet the sector as a whole has had a tremendous amount of money flock to it. And so when I look at where we are, the deficits that we're running, it's not this year I'm concerned about, right? And then we also have to talk about the refinancing of a lot of debt coming due for commercial real estate, right? There's a tremendous amount of debt that needs to be refinanced. We talked about Realty Income's debt maturities. We've talked about a bunch of different companies' debt maturities. Intel recently, we dove into their debt maturities. And to me, the debt maturities is a bigger conversation than Wall Street's actually bringing up. Because when we think about 0% interest rates for the last 20 years, and now these companies, especially companies that rely on the debt market, these companies now are going to be dealing with 5 times higher expenses on deficits, right? And when I look at deficits being run within the government and within businesses, to me, I think we're going to have muted returns going forward, and we're going to see GDP really take a U-turn probably over the next 5 or 6 years, because I do truly believe that we will start feeling the pain of the interest rate environment that we're in, and it will be delayed. And a lot of people are saying to themselves probably, well, we would already be feeling that pain. And I think some companies are feeling that pain when we think about Dollar Tree or Dollar General closing stores. There's been a tremendous amount of stores being closed. Just in general, a lot of jobs are being cut, but it hasn't really impacted the labor market quite yet. And the reason why I think that is the case is because of the amount of stimulus that the government has passed over the last few years. And that's just keeping everything afloat at this point in time. So there's a couple good questions in here. AO is saying, don't markets usually go up when interest rates come down? And we're talking about elections year. And the answer is yes. During election year, there's a lot of hype, a lot of excitement. And so that's why I'm saying I do think over the next the initial reaction, AO, is that interest rate cuts in election years will bring those opportunities. But in my opinion, I think when you're talking about interest rate cuts, something might have to go wrong for them to actually cut rates, right? I know Powell has stated that he's definitely looking to pull the trigger on rate cuts. But when I think about kind of where we are in the economic cycle and where we're trading on valuations, I think we're at a very, very end of cycle behavior in a lot of ways. And so that's kind of been my thesis, and my thesis has been delayed, and I don't want to make excuses. That means I've been wrong, absolutely been wrong. But I think a big reason why I'm wrong is the amount of stimulus that the government has been passing. So rates are, the Federal Reserve is trying to tighten the economy and slow it down, but the government's trying to stimulate the economy and keep it growing. And so it's been a kind of a battle of two stories. And at some point in time, I think something breaks that we didn't see break. But you are correct. Markets usually will do better in election years and when interest rate cuts initially happen, unless those interest rate cuts are taking place because of something breaking. So yes, you are correct on that. And that's why I think 2024 will probably still stay in a bull market. So I am behind your thesis. So I'm agreeing with what you're saying, AO. Where we're kind of disagreeing, or where you're not maybe understanding where I'm coming from, is this is a longer term problem where I think it's a 2025 beyond problem. And so I think that's when the muted returns come for the markets. So we've been dealing with pretty easy growth. It's been an easy market to invest in overall. It's definitely been a stock picker's market as of late. But I would say, like, when we think about the deficits that we're running, government spending has to slow down. When government spending slows down, this is going to impact growth in the economy because we're a debt-based system. Then we factor in, if government spending slows down but rates are still somewhat elevated, that's a double headwind. Is that going to happen this year? I don't think it's going to happen this year. But what I'm trying to say is the companies that I really focus on this channel, and most of you guys probably know, are companies that are really not getting covered. And that where I don't think they're not truly priced to perfection, right? And so those are the companies that I personally look for, because if a company's being talked about every single day, and if everybody's making YouTube videos on them, then it's already probably priced for perfection, right? It's getting so much coverage, so much love, so much money flowing to it that the underlying assets already probably priced into perfection. When we look at some of these other companies that have kind of been left for dead or just not getting the coverage that they deserve. And, I'm going to bring up Dutch Brothers, right? And now this is a dangerous investment. It's a company still in the growth phase, but there's not a tremendous amount of content being created on this company. And so when I saw the growth rate of this company, and I saw the opportunity, and I saw that Starbucks had a bad quarter, but yet Dutch Brothers is actually knocking the ball out of the park, but wasn't getting any coverage, I thought this was an interesting stock pick, and that's how I started building my thesis around Dutch Brothers, right? And then we could go down the line. Gilead Science is another one that I'm starting to get more and more bullish on the more I look at it, because it's one of those stocks that's really kind of been left for dead, has a very strong dividend yield, and I do think there's plenty of opportunities in its pipeline to really catch the market off guard, because what's being priced into perfection on the healthcare side is all these companies that have the weight loss drugs, right? All these companies that have the weight loss drugs have gotten ridiculous valuation growth, ridiculous multiple expansion, but yet what is left for dead? PFIZER, Gilead Science, those type of companies that, yes, they're probably going to miss this, opportunity in the weight loss section for the next 4 to 5 years. But what's that 5+ years look like for some of the oncology and some of the cancer treatments that they have in their pipeline that could come to fruition and really turn the stock back around? And so that's kind of the mentality that I take. It's definitely more contrarian type of mindset. So that's why when I'm looking at stocks, I'm looking at something that needs to be deeply discounted versus its peers, but still have some sort of big opportunities. And so when I look at cybersecurity, and I've kind of done this through a few different times, I'll definitely take a look at Estee Lauder. I got a bunch of call outs, guys. I want to make it clear. I got a bunch of call outs. I'm actually going to start writing them down now. Estee Lauder was one, and then VFC. I think it was VFC was another one. But I have about 5 or 6. I'm probably going to do a dedicated subscriber video very, very soon, and just it'll probably be like 40-50 minutes long, and I'll timestamp it with all the requests that I've been getting to do on some of the breakdowns on individual stocks. I know somebody else talked about British Tobacco, which to me, I think British Tobacco, anything under 29, anything around that $29 is a buy. The problem becomes the political shadowing that's in British Tobacco, right? There's a lot of risk with owning these types of companies. Government's trying to ban certain things. So you have to understand, like, with that, this is not a company you want to put a tremendous amount of capital in, and thinking that it's a safe bet, because there is a lot of risk with those types of companies. And the more we're starting to see, there's a lot of risk with even some of the safer companies that we thought about when we think about kind of what's happened to Apple, what's going on with Tesla. But yeah, so you always have to keep an even mind, not get too bullish on any position. Always look at it from an open standpoint of there is a bullish case and there is a bearish case, and you have to, when you own a specific stock, you have to start looking at both sides of it. And I'll throw myself out there as an example. As most of you guys know, I'm extremely bullish on CVS. I think they're in an interesting position with the acquisitions to really get healthcare costs under control and really have a flywheel business that nobody's seen. But I'm also starting to look at the bearish case of the margin compression that's taking place. If they don't turn things around quick, I'm going to be in a bad situation with CVS, and I have to start looking at it and saying maybe I'm wrong, because I don't think it's the acquisitions that's a problem. I think it's management execution, and I also think it's healthcare costs that are out of their control. That was the biggest problem. And when we dove into their quarterly report, that was clear as day to see that the healthcare expenses is really what's driving the stock down, in my opinion. Would have been a strong quarter if those, well, I think if I remember correctly, I believe it was a $7 billion in one quarter hit on healthcare expenses going up. And they still, are running a good business. So valuation obviously looks a little more expensive now, but after the sell-off, now it's back in line. This is definitely a company that has to prove itself in order to get that valuation expansion. But at some point in time, I might have to look at this and say, management is not executing, and I might cut my position in half and put it into an opportunity I think is better fit. So that's the part of being a stock picker and managing your own account that's stressful, and that's why I recommend do dollar cost averaging into a broadly diversified index. Obviously, with my thoughts on indexes kind of pushing markets higher, I'd rather see an equal weighted index going forward. But so I wanted to hop on here and kind of just talk through some things. So we got an important week of data coming up here, and I would just keep an eye on everything. And I do think with where deficits are running, where valuations are, I just think more than not, we're going to have muted returns going forward. And so the stocks that I'm picking and how I'm offsetting what my thesis is, 2025 and beyond of muted returns, I think you have to be looking at deeply discounted stocks that are discounted right now in order to really have that market outperformance. And so that's what my main focus has been on probably the last 12 months, I would say. The last 12 months, my focus is, finding really, really deep value companies that kind of are not getting a lot of coverage. Price action has been stagnant, but I do think that there is a catalyst in their business to send it in a better direction than the market's going. So I think they could be market outperformers. And that's what my main focus has been on the channel, and not kind of falling into the popularity of a lot of these stocks. Now, of course, I personally have to, talk about some popular stocks to kind of grow the channel. Unfortunately, it's just part of what it is. But yeah, so I wanted to give you guys kind of an idea of what to look for over the next few weeks here. So we got some big data points. I'm going to be pushing some videos out on a lot of the subscriber requests. I'm probably going to just do a massive video for a lot of the callouts that we've been getting. But yeah, I don't want to be doom and gloom. I'm just trying to be as open and honest as possible. I hope I'm wrong. But I do think how fast markets have moved, how much deficits we're running at some point in time with higher interest rates, we're going to have muted returns. It's just a matter of when. And so I'm trying to prepare people that are subscribed to my channel on my thought process of that. And that's why I've been looking at more contrarian type stocks. So, if you're wondering, like, why is he bringing up a name like this, and why is he not talking about a SoFi or a Palantir or whatever else is really popular, it's because I really think there's a lot of perfection priced into those stocks. And you can just look at the earnings reaction on recent earnings of these stocks. It's pretty clear that there was price perfection in those names. And so for me, I think that there's thousands of other stocks that are not being talked about that I think have really good upside potential and more of defensive earnings. Hold on one second. I see this question here. Do you have any stocks outside the U.S.? So outside the U.S., I normally rely on indexes or mutual funds or like an ETF on emerging markets. But yes, there is a few small cap companies that are outside the U.S. that I actually think are pretty big opportunities. I've talked about a few of them, but I will kind of touch on foreign names. InMode was one. They're obviously going through a war, so the ticker symbol INMD. That was an interesting name, tremendous growth. There's a company called Cint, CINT. Could have some AI capabilities, very, very cheap stock. There was a few other ones that I would have to go through, but off the top of my head, that's kind of some that come to mind. So, yeah, and Anthony, I agree with you. Most definitely there is price perfection, but there are some good deals out there, and that's exactly where my head is. My head is exactly in the same spot as not really following what everybody else is talking about, but taking a look at the contrarian side of things that can actually outperform. But more than anything, we talk about price action following EPS, right? Price action always follows earnings per share, okay? And so I want to pull up a stock here that I talked about, and this one kind of kills me a little bit because I owned it and I sold it for a small amount, and I want to show you guys something here. This company gets no love, and I talked about this company around $15 a share. Okay, this is Gen Digital. This is one of those contrarian type of plays when we talk about cybersecurity, right? It's not in the Fortinet, it's not in the Palantir, it's not in this excitement of getting those big contracts, but what they do is they have kind of your consumer cybersecurity name with Avast and LifeLock and all those type of things to protect our identity. And I thought that we could see a massive wave of hacking and bank account information being compromised with the movement of AI. And this stock was definitely in a perfect position, and it kind of got away from me. And this one I think is going to be a huge outperformer. I'd love to get it back in the high teens if possible, if we get a market pullback. But this is just a company that's done everything right. I believe when I was looking at it, it was trading at 12 or 13 times earnings. Nearly 40% or 30% of the top line revenue goes down to free cash flow. They're buying back a massive amount of stock for the market cap that it has. It's only a $14 billion market cap. When I was looking at it, it was right around $10 billion. So there's these types of names out there that don't get a lot of love. But if you take a look at that chart, especially where we had it kind of earmarked for right around $15, $16, that is a heck of a return, and it paid over a 3% dividend, I believe, if you got in at those levels. And this is a company that is smaller cap company that was trading at a reasonable valuation that I felt like was in a right place at the right time, that was getting overlooked by the market. And now all of a sudden they have really good earnings and they're doing a massive buyback now. So Those are out there, guys. Those opportunities are out there. The unfortunate thing is as a YouTuber, you don't get views for talking about a company like Gen Digital. Nobody's going to talk about it. There's another interesting name that I want to point out here, and there's two of them. So Cisco Systems, which I brought up numerous times. Cisco Systems to me is an interesting way to play cybersecurity from a distance. I do think it's not cheap. I think it's not expensive. I think it's valued at a reasonable price. When we look at the price action of this company, it's basically just traded sideways. But when we went through the recent acquisitions that this company has made, this company has been a monster acquisition play over the last 3 years. And a lot of their acquisitions have been based in the cybersecurity space. And so what are we going to see happen here? Could we see Cisco Systems become more of a SaaS business and really not as reliant on the hardware aspect of their business, which the hardware aspect of their business should have a pretty substantial earnings increase with the build out of AI, right? So this is a name that I've been looking at. Another one that, I want to see play out here is going to be HPE with the acquisition of Juniper. And these companies, they're not cheap, but they're not expensive. They're trading below market multiples. As we saw, Cisco Systems is trading at 14 times earnings. I believe a forward PE of 13, maybe 13 and a half. So you're talking about 14 times earnings when the market's trading at 26 times earnings. And this is a company that I think could have above average growth with the recent acquisitions of Splunk and other cybersecurity companies. Same thing could be said with Hewlett Packard now acquiring Juniper, right? This is going to be an interesting one to watch. I don't think I'm ready to buy it quite yet. I think we could see it get into the $14 range, maybe even the $13 range. And I think that's where it gets interesting. We're going to probably do a deep dive in their earnings breakdowns when they report. So just some interesting names of companies that I think are valued appropriately, have good balance sheets, have decent earnings, and I think could have accelerated growth that's getting overlooked by the market because of all the hype stocks that are out there. And these are companies with pretty strong fundamentals. These are companies that have free cash flow. They have cash on their balance sheet, good management in place, pay dividends, valuations are appropriate. They're not on sale. I'm not going to come out here and say that they're screaming deals, but they're definitely ones that you kind of want to put on your watch list. So these are just some names that I'm personally looking at. Boring names that I think could break out. And I brought Microsoft up numerous times on the channel. When we look at Microsoft's history, take a look at Microsoft's history, 25 years back or whatever, and look at the stock chart on Microsoft. It wasn't until they really started making acquisitions and getting deeper kind of flywheel business model that it all of a sudden exploded. And I think that there's a couple of those legacy type companies out there that have strong enough fundamentals to make these acquisitions that'll eventually pay monstrosity returns as long as they made good acquisitions and good managements in place over the next 10 years. I'm not saying that they could be the next Microsoft, but they could be a $500 billion company. When I look at Cisco, would it be that outrageous that they could do something like that? I don't know. Only time will tell. But as always, guys, I really appreciate everybody's time. Wanted to jump on here, kind of go through some things. Obviously we're seeing opportunities in the parts of the market where there's not a lot of coverage, and that's what I like. So really appreciate everybody. I know we got a lot of new subscribers. Thanks for the love, everybody. And hopefully everybody has a great weekend. I will be going over, doing some videos over the week on, what the feds are doing as far as, PPI, CPI. So we'll get into that as the week progresses. And we will see you in the next one, ladies and gentlemen. Peace.